briefly, simply level, and I told you we'll do a lot more later. Well, this is the later. Here we are. So we're going to do property, plant, and equipment, and depreciation of those. What's the deal? Depreciation is what? I am using up the utility value of the asset. So, when UPS buys a truck, does UPS really care how much its value in terms of market value is changing over the life of the truck? Not particularly. Why not? They're not going to sell it. They are going to use it up. So let's say they pay $100,000 to buy a truck. They're going to sell it at the end for $2,000, guys. It's going to have 400,000 miles on it or something, right? You got the idea? It's going to be used up, right? They're using the whole thing. They're going to sell it for almost nothing. So what do they care about? How much use they get out of it. They care how many miles they get out of it, how many hours they get out of it. Every machine and company buys is like that. Buildings are like that. You're not buying it to resell it. It's not for appreciation. Now, if you are buying it for appreciation, that's different. We use a different type of accounting for that. If you're a land developer or something like that, or a dealer in antiques or something, right? You know, those types of things we would handle differently, okay? We put them in a markup, basically. So what we're doing is we're recording the historical cost of these assets, what it costs us, and then we're spreading the cost over its life, which is what depreciation is, right? And we bought the piece of equipment, UPS bought the truck, to do what with it? Deliver packages, which is how they earn their revenues. So one of the costs of earning those revenues is, of course, the truck, right? So the depreciation is a what? Cost of getting the revenues, which makes it a what? Expense. Yeah, you got it. If you know the cost of earning revenues or expenses, that's a big thing, you guys. And all of you guys are kind of like, well, yeah, no, always. That's good. That's where I want you to be right now. Okay? Yeah, so it's an expense, isn't it? So all we're going to do here is we're going to determine an estimate of how much of an asset we used up in each year. That's what these different methods are for. Right? Okay? By the way, depreciation expense is an expense account, goes in which financial statement? Income statement, good. Okay, and then what is the other side? It's debit, depreciation, expense, credit, what? What do you credit? No. Well, you credit revenue when you're in revenue, but I mean when you record depreciation, you debit depreciation expense and credit what? Accumulated depreciation. Yes, we would be recording the revenues here. That'd be debit cash or account receiving credit revenues. So yeah. Okay, debit depreciation expense, credit accumulated depreciation, right? What kind of account is accumulated depreciation? It's an asset, but it's got a credit balance, so it is a contra asset, sure. And what we're doing is we're increasing that as we use up the asset. So let's say I paid that $100,000 for the truck. The first year I use up 20 of it. I put a credit balance in accumulated depreciation, wouldn't I? And I show a $100,000 truck less 20,000 accumulated depreciation for a net book value of 80. And the book value represents what I have not used up of the original cost, right? Does that sound kind of like what we did with the accounts receivable and the allowance? Exactly, isn't it? Okay? Exactly the same idea with the contract side, isn't it? Okay. Why don't we directly reduce the truck? Why don't we just credit equipment for $20,000? What do you think? We still have the equipment, and we want to show what we paid for it. Plus, now you can sort of tell about how old they are. What if a company has $100 million in equipment and only $10 million in accumulated depreciation? It's pretty new equipment. What if they have $100 million of equipment and $90 million of accumulated depreciation? They need to replace all of it. Does that change your perspective on the company? Sure. You got the idea? So it's kind of useful. Okay? Kind of useful. All right, everybody got the idea what we're doing here? Why do we use different methods? The one we did so far was straight line, huh? We assume we use up the same amount every single year. Is that really true for assets? When UPS buys a brand new truck, how much maintenance cost do you think they have, and how many breakdowns which keep them from delivering product and all that kind of stuff, and they have to go fix it? And give the idea. But what kind of costs do they have related to that asset other than, fuel and changing oil? Pretty much nothing, right? In the early years. Do any of you guys have an old vehicle? And your college kids, I bet you do. What's your maintenance cost like? My Miata has only 75,000 miles, less than that, 73,000 miles on it, but it's a 2,000 new guys, right? My wife drove it about 30,000 miles a year for 2 years, and they gave it to me, and I only put on 1,500 to 2,000 a year, going back and forth to school, basically. Keep it running, but I like it, right? So, you know, so it's going to last a really long time, but you know what? One of the windows quit working, quit going up and down. I have a convertible with a window that doesn't go up and down, so after about 6 months, I got really sick of it. It only cost me $500 to fix the window. Because they put in one with a motor. Why does it have a crank? We just put it across the car. I wondered that when we bought it. Why are they powered? So they get the money when quit working, I guess. Okay, anyway. So, you guys with old cars, what's happening? You gotta fix them constantly. Anybody have a new car? You get pretty new? You don't do anything to it, do you? Except make that big payment, right? Yeah, okay. So you get the idea? Might a vehicle, right, for instance, that type of equipment, get used up more in the earlier years? You know, you get more depreciation maybe in the earlier years. Its utility is being used up more in earlier years, and then maybe you have more maintenance costs in later years. Got the idea? It's less valuable to you in later years, maybe. Everybody got the idea? So you might do that. So we have these accelerated methods. Now there's one other thing. For tax purposes, we use something called Modified Accelerated Cost Recovery System. The Accelerated Cost Recovery System only lasted, I think, a year or something, and then they put in the modified one, and it's been around forever, but it's tax law. Okay, so that's what it is. What it is extremely short lives and accelerated methods. Far shorter life than the asset's going to really last. And real accelerated methods. And you calculate your depreciation for your tax return using that. What's the benefit of that? Huge depreciation in the early years. So I buy a new asset and I depreciate it really rapidly, right? What happens? I have more depreciation expense, therefore less what? Less taxable income. You got it, and I pay less taxes. But you know what? In the later years, if I keep that asset, what's going to happen? I'm going to have to pay more taxes then because I'll have very little depreciation left in the later years, right? So that's where some of this comes in. Now, for financial statement purposes, oh, by the way, what does that motivate people to do, seeing as they're not going to have much tax breaks in later years? Sell the asset and buy a new one. But they don't throw them away. They sell them to smaller businesses. So UPS buys a truck. They use up the truck, basically. It needs to be rebuilt. Somebody buys it, rebuilds it. The smaller companies can afford equipment. That's not all bad, right? It's okay. Now, to the extent that we throw things away that aren't used up yet, that's kind of bad for the environment, maybe. But it does create jobs producing assets, doesn't it? So there's a reason that Congress would have this accelerated depreciation. Saves people tax dollars that they really like, right? So their constituents are real happy. Businesses, for the most part, but individuals do, right? They get tax breaks, but also maybe it creates some jobs. Maybe it does, right? Encourages business activity, right? So, maybe not all that. Anyway, so we have to separate financial statement depreciation from tax depreciation now. And that creates this thing called deferred income tax. What does defer mean? Put off, right? I put off the tax till later. So what you do is you buy new assets continuously. You have high depreciation on those. That lowers your taxes, and you're going to pay the taxes later, right? And you can put them off kind of permanently if you keep buying new assets, which of course is probably good for the economy, right? Good for the environment, good for the economy. Okay? So trade-offs. Anyway, so we'll separate those. It creates something called deferred income taxes, which we're going to have later, and it is a liability. I still owe the taxes. I'm just not paying them now. A lot of times it's a long-term liability, right? Sometimes it'd be a current liability if I'm going to pay it the next year. Okay, so we'll worry about that when we get a little bit into liabilities. So let's do some methods here. First let's buy an asset, huh? Let's buy that truck. I want to buy it for $120,000. Let's buy a truck for $120,000, and then let's assume we're going to use it for 5 years, and we are going to sell it for $20,000 at the end of the 5 years. Just to make my math work out. Okay? That way I only have $100,000 to depreciate, right? So how would you record that, by the way? Let's say I bought it with 10% down, and I financed 90%. I bought a truck for $120,000, 10% down. Finance the rest. Debit what? What'd you get? Come on, you guys. Trucks. Trucks or equipment or something, right? For 120,000, everybody agree with that? Okay, what do you want to credit? Cash, how much? I said 10%, 12,000. What else do we want to credit? Accounts. They're going to trust you on an open account for that much money? No. I bet they make you sign a piece of paper called a note. Excellent. Okay. Note payable. Next. Okay, how much is that? Come on, you guys. 108,000. Okay. Yeah. That's it, isn't it? Okay. That's where we'd be. So you know that in the truck account you got 120, and accumulated depreciation right now you have nothing. You haven't used up any of it, right? So when we're doing the book value of this piece of equipment, we're going to take the truck less the accumulated depreciation as it grows. So what did I say, a 5-year life? And let's say 20,000, I said salvage value. Salvage value or residual value mean the same thing, okay? It's what's left at the end. It's my estimate I'm going to sell it for when I'm done with it. Everybody got the idea? Not complex stuff, is it? Okay, just learning business terminology. Okay, so when I do my depreciation, let's start with using straight line. If I wanted to do straight line depreciation, what am I going to do? How much? What portion of the depreciation do I want each year? Straight line. 5 year. 1/5. That's it. It's going to be 1/5 depreciated every year. Now the question I have for you is, do you want to depreciate that 120,000 up there, or would you rather depreciate just the 100,000 that you're going to use up? What should depreciation reflect? What you're going to use up? So it's the 100,000, isn't it? And that way we'll stop depreciating when we get down to the salvage value. Everybody hear that? That's what we want. We don't want to go beyond that. Okay? No matter what method we use, we don't want to go beyond the salvage value. Because they're going to try and sell it for the salvage value and not have a gain or a loss at that point. Just sell it. By the way, what if I depreciate it down to 20,000 and I sell it for more than 20,000? What do I have? A gain, of course, right? What do I have if I sell it for less than 20,000 if I depreciate it down to that? A loss. So we're going to be able to handle that too, right? You guys already have the tools for doing that, figuring it out yourself, don't you? In fact, when I say something like that, you kind of just think, yeah, that makes sense. I bet I can even formulate the journal entry, huh? By the way, if you get rid of the asset, what do you need to get rid of off of your balance sheet? Probably the equipment. You don't have it anymore. What else should you get rid of? The accumulated depreciation, because you don't have the equipment anymore. What if I had a $120,000 truck and I depreciated $100,000? I make the truck zero. If I leave the $100,000 accumulated depreciation on what do I have? 0 minus 100, a negative $100,000 asset or something? Of course you don't have that. You have to get rid of the accumulated depreciation. Do you have to record the cash you sold it for? Or whatever asset you got for it? Sure. And the difference is going to be what? The difference between the cash and that book value when you sold it is going to be what? Gain or loss. 20,000 book value. Sell it for 22. What do you have? Gain of 2. Sell it for 16. What do you have? Loss of 4. People actually miss this on quizzes and tests, you guys. You're not going to, right? You know why you're not? It's because you're reading chapters, working your ass off. You're coming in here and you're actually listening to me. And then you go practice a little bit now, don't you? You start to do it. And it's really showing. Really shows in your quizzes. It's fantastic. Maybe I'll have some of you come and visit next spring. Never mind. Yeah. Okay. All right. Tell people how to succeed. All right. Anyway, let's do straight line. We've got the cost. How much? 120. So this is how we do it. Subtract what? 20. We already did this, didn't we? Right? And then what's the net? Yeah, this is my depreciable value, I'd say, because it's the amount I'm going to depreciate. Sound good? You don't have to really name it, but that's what it is. 100,000. Okay. I am going to stop depreciating when I get 100,000 accumulated depreciation, no matter what method I use. Okay, so let's do straight line. What do we say? 5 years? So what would you do? Take the 100,000 and divide it by what? Divide it by 5 years. That's it. What do you want each year? 20,000. That's it. Okay, now, how about if I only hold the asset for half a year in my first year? And my year ends December 31st, I buy it July 1st. What would I do? 20,000 divided by 12 would give me how much it would be for 1 month, right? And then if I had 6 months I held it, I'd take it times 6. What if I only held it for 5 months? I'd take it times 5. We need to do other months. Everybody's got it, right? So you could depreciate something for 1 month, 2 months, whatever it is, whatever portion you held it. And then what will happen is you'll add a year on the other end that picks up the rest of the months. Does that make sense? Okay? No big deal, huh? Okay, good. Excellent. So you can handle that. All right, anyway, let's do journal entries. What are we going to do? At the end of the first year, let's say we held it for the full year. Debit what? Always, no matter what the method is. Oh, by the way, when you did the quiz, some of you did not, on the bad debt expense, some of you did not every single time debit bad debt expense and credit accumulated depreciation. That's how you record bad debt expense. That's how you replenish the account, am I right? Why did you get flustered and hit accounts receivable and hit sales and did all kinds of stuff that made no sense? Every single one of the entries for that, all 4 of them with the 4 different ways I had to calculate it were what? Debit, bad debt expense, and credit accumulated depreciation. The only problem you have is determining the amount. It doesn't change because the situation changes, okay? Don't do that again. Don't let yourself do that, okay? Don't panic and have the brain just disappear on you, which is really, really easy to do. Everybody does this, right? Stage fright when you're speaking, what happens? Your brain shuts down and you're an idiot, a blithering idiot, right? And you do exactly what you were going to say. So relax, okay? Relax. If you don't get everything right, so what? What do you have to get right in here to get an A? A solid A, 80%. You only have to be right 80% of the time. If you want to become a CPA, how what percent do you have to get right on the CPA exam? 75. Come on. Experts don't know everything. How can they possibly? There's way too much stuff to know. Relax. Relax about it. And I know you're used to in high school what? Memorize everything and get 99%, huh? You feel really bad if you got 95. Oh my gosh, I didn't perform very well. All they're doing is they're asking stuff they know you know. I guess it makes you feel good, but I don't think it accomplishes much else. What I want you to do is learn as much as you possibly learn. And then show it. And if you get 95% of the points in here, I'll think, wow, that's pretty cool. Let's see what you can do in intermediate. I mean, let's keep going. Let's see what you can do in your career. Right? It's okay. Right? But you'd be quite successful at getting 60% of the points. That's a B, isn't it? Something like that? It's terrible how easy to upgrade. Okay, anyway. All right. Journal entry, debit what? We actually said it, didn't we? Debit depreciation expense, 20,000. Credit what? Accumulated depreciation, 20,000. Okay, excellent. Here we go. What is the balance now in equipment? Trucks, I guess it was. My name's the same, I guess. It's the balance in trucks. Now, what's the balance in trucks? Careful. Wow, that's tough, isn't it? The net book value is 100. You're right. But what's the balance in trucks? 120. And a common mistake is people will pick up the 100 that's the depreciable value and say that's where I started. No, I'm starting at 120, aren't I? Okay? And then accumulated depreciation is what? When you put this in here, didn't you? 20,000. Everybody agree? What is my net book value I show on my balance sheet? I'm going to show 120 truck, less 20,000 accumulated depreciation. I will have what? 100,000. Everybody good? Net book value. That's it. Okay? What else do I have going on? I'm debiting depreciation expense, aren't I? Everybody agree? So this is just reflecting what's happening in the general ledger, right? It's 20,000 also. But what happens to that 20,000? I put it on my income statement, it reduces my net income by 20 because that's a cost I incurred to get my revenues, right? What happens to that account before I start it again? You close it, because you close all the revenue expense accounts. Great. So this one goes away with the closing entry, doesn't it? So I'm going to close this one, and I start over. Everybody got it? Okay, so now I start the new year with 0 in depreciation expense. What am I going to do the second year? I don't have to write this down, do I? Same thing, right? Year after year after year, 5 times. I'm going to do this 5 times, aren't I? Okay? So what's going to happen is the second year, I'll put another 20 into accumulated depreciation. Everybody agree? And I'll put another 20 into depreciation expense. Now what do I have on my balance sheet? $120,000 truck less what? 40,000 accumulated depreciation, 80 left to use up. Everybody good? Okay? That's after 2 years. Okay? And then what do I do on the income statement, on the depreciation expense rather? Close it and start over. Everybody good? But where am I closing that to anyway? Well, I'm closing it so I can start the next year. Retained earnings, which is an equity account. I close it to retained earnings on it. I'm making retained earnings 20,000 less each year on it. So if I got 40,000 in accumulated depreciation, right? How much have I taken out of retained earnings? 40,000. Right? That's what's happening, isn't it? I'm using up the asset. Now, hopefully, I'm generating revenues that are increasing my assets, right? And the revenue's cash, accounts receivable, and so on. Is that good? Everybody like it? Okay. So let's do the third year. What do I have? Same thing. 20 here, 20 more here. Where am I at? 60? What's my remaining book value? So if I gave you a question on a quiz, straight line depreciation, what's the remaining book value after 3 years? Could you do the entries that are necessary? You don't have to write them all down or anything. But could you do the entries that are necessary to get to the point where you have 60,000 here in accumulated depreciation? Take 60 away from 120 and tell me it's 60? Sure. You do this, good. Okay? All right, and then we close this one. We're tired of this? Oh. Okay, and then we do 20, we do it again, right? So we do it 5 times. 5. Okay, so we do it again. Put another 20 in here. And that brings us up to 80, and now where will we be? Book value of 40. Okay, and let's do it one more time. So we close this, and we do it one more time. Okay, so now what do we have in accumulated depreciation? 1, 2, 3, 4, 5. That was 5, wasn't it? What do I want to do now? What's that?
Credit to the trucks.
No, not yet. Only when I sell it. What if I keep using it? It's kind of free from a depreciation standpoint. If you estimate your life wrong, right, you use it longer, you just quit depreciating. Don't keep depreciating. You stop. Now, we're going to be able to change depreciable life, and we're going to be able to change salvage value. We can do that, right? But for now, we just stop, okay? Until you sell it. And then when you sell it, you'll get rid of the equipment and get rid of the accumulated depreciation. Okay? Sell it or just give it away, retire it, okay, junk it, whatever you're going to do. Okay, everybody see what's going on here? Is this easy? Okay, good. So we close that one too, and we start over with it. All right? So, let's try a different method then, huh? Let's try one of the accelerated methods. Let's go with double declining balance. And by the way, there are a whole bunch of different, that's 200% of declining balance, another way to say it. You could do 150% declining balance if you want, or 125 or 175, right? A few different ones. Okay, but double is common, okay? So double declining balance just means twice straight line, but be very careful. Listen to this one carefully. It's not twice the depreciation expense straight line would be. It's twice the percentage straight line would be. Makes a big difference. Okay. So what we're going to do is, what is the percentage that straight line hits each year? In this case, 1/5 is what? 20%. What's double that? 40. We are going to take 40% then, in the case of a 5-year life, double declining balance. We're going to take 40% of the remaining book value each year. Of the remaining book value. What's the book value? Cost less accumulated depreciation, right guys? Now why do we use the cost instead of the depreciable value? Why do you think you do that? I'm always taking a percent of what's left. If I only used 100,000 in our example here, I would never get down to 0. I'd never use it all up, right? Because I'm always taking, in this case, 40% of what's left. Does that make sense? Okay? So I have to use the full value. Declining balance is the only one, right, where you use the full value, the full cost. All the other ones are going to use the depreciable value to depreciate. Straight line does, because I'm going to depreciate 100% of it, right, across the years. Okay? Same thing if I was doing units of production, if they give you a chunk. And I'm going to give you one more just for fun. Some of the years digits, sometimes years. Okay? Just because it's so easy. Okay? More than your money's worth. Yeah. Okay. Anyway, so here we go. Let's do double declining balance. Give this thing a try. How's this one going to work? Let's get rid of first. All that stuff. Do it again. Do this one. All right, here we go. All right, double declining balance. Straight line would have been what? 1/5 per year, right? Okay, which is, of course, 20%. And then if I double that, I take it times 2, and I get 40%. By the way, what if it was 150% declining balance? I take 20% times 1.5. Everybody got it? I get 30%. You could do this, couldn't you? So read carefully. I'll give you something different. It's all right. Okay, so 40%. So what I'm going to need to do is keep track of the remaining book value year after year after year. And I'm always going to take 40% of it, okay? So what I'm going to have is the cost is 120, right? The cost less the accumulated depreciation is the remaining book value. Everybody good? Okay. So let's put the book value here at the beginning. So year 1, year 2, year 3, year 4, year 5. Okay, guys? So let's do that. Are we going to go down? Don't do that. Oh, shoot. There. All right. Okay. So we'll do the book value, okay? And then we'll take 40% of that, which will be the depreciation expense, okay? And then we'll get the accumulated depreciation. So that's the book value at the beginning of the year's what I put here. And I don't care what order you put those in. You can do the author's way or mine. I do it different ways, different times. What's the beginning book value, though? Seeing as we have no accumulated depreciation. It's 120, isn't it? Right? 120 less 0 is 120. So this is 120,000. Everybody good? So assuming I hold it for the whole year. By the way, if I use it for part of the year, I calculate what the whole year would be, and then divide by 12, take it times the number of months. Right? That's all it is. Easy. Okay. So what would I do here? 120 times 40%? How much is that the first year? Now, what would straight line have been? 20. You see how this is more than double straight line? It's double the percentage of straight line, isn't it? The straight line was 20, double would have been 40. Everybody got it? So it's 48. Don't just double it. Okay? It's double the percentage. All right. So journal entry for that? We'll just put them straight into the T accounts here. I still have trucks for 120,000. I'm going to accumulate depreciation, right, guys? Over the life of the truck, over the 5 years. And every year I'm going to record depreciation expense on my income statement, right? So what's the first year look like? Debit what? Depreciation expense. See, the entry didn't change, right? The entry's the same, just like in that bad debt expense thing. It's the dollar amounts changing. It's debit depreciation expense, because I computed it should be 48,000. And what am I going to credit? Accumulated depreciation. That's what you always do, right, guys? Everybody good? So my accumulated depreciation will be $48,000. Does everybody agree with that? Now what's my remaining book value at the beginning of the second year? 72. It's 120 less 48. 72. Fantastic. Everybody see it? That's my remaining book value. And now what do I want to take the second year? 40% of that. Good. All right, so let's take 40% of that guy. What is it? 28.8. Now it's way beyond my math skills. Okay, what's the journal entry going to be? Debit what? Oh, I closed this one, right, guys? Start over there. Yeah, I hit the income statement, disclose retained earnings, right? I reduced the asset by increasing accumulated depreciation, and I reduced retained earnings, reducing equity. Stating balance on our balance sheet, didn't we? Okay, what do I do then with this 28.8? Yeah, debit depreciation expense, and credit accumulated depreciation. Oh, and now I have 48 plus 28.8, don't I? Everybody good? This is working, isn't it? Big deal, it's a different number. Okay, so how much is your accumulated depreciation now?
76.
Look at how fast this is, this double declining balance. Okay? But if you think this is how the asset's being used up, this is what you would do. Okay? Think it's being used up this fast. Okay? All right, so then what do we do? What's my remaining book value? Keep taking your 120 cost less the accumulated depreciation in total, okay? Everybody agree? So it'd be 120 less 76.8 is how much? 43.2. Now what would you do that year?
Same thing.
Take 40% of it, and that's going to be your depreciation expense, right? How much is 40% of 43.2?
17,280.
Excellent. Debit depreciation expense, 17,280. Oh, I didn't close it again, did I? You guys do realize we closed before we put in the new entry? Let's hope, right? Start a new year. Okay, better remember to do that. So we put 17,280 credit to accumulated depreciation. Everybody staying with me? Debit depreciation expense, credit accumulated depreciation, same entry, isn't it? Okay, so now what's my balance in accumulated depreciation? 94,80. Okay, we got it. All right. What's my remaining book value? Subtract 120 less 94,080. 25920. All right. Close this one, right? It's gone. Okay. What's 40% of that?
10,368.
Okay. Debit depreciation expense, credit accumulated depreciation. How much do I have in accumulated depreciation now?
40,448.
And everybody's happy with that, right? You guys are perfectly happy. What's my remaining book value? How much is that? 15,552. I think you guys screwed up. What was my residual or salvage value? 20,000. What do I have to do? Stop when I get to 20. I don't like your entry, guys. I don't like your 10,368. Do you? I don't like that anymore. What do you want to do? This is a little tougher. When do I need to stop depreciating, gang? When my accumulated depreciation gets up to what? 100,000. You got to remember to stop. I'm going to have nothing in the 5th year down here because I'm up to, my book value is down to the $100,000, right? Okay, it's going to be down to the $100,000. So, let's look at this. How much do I need to get from 94,000 to 100? It's going to change, isn't it? How much do I need to get there? You guys are at 95,000. How much do you need to get to 100? Yeah, 5,980. Is that what that was? 920. 5,920? You bet. Debit depreciation expense, 5,920 in the 4th year, and credit accumulated depreciation, 5,920. And that's going to give us our 100,000 in accumulated depreciation and our remaining book value of 20, isn't it? So what am I going to have for depreciation expense in the 5th year, this strange example I did? None. So you force the life to be shorter, basically, is what happens. So here's what you do. When you're using a declining balance method, a lot of times what you do is set no salvage value. So we'll try it that way now, okay? But if you did set a salvage value, you got to stop when you get to salvage value, okay? You have to stop. But if we set no salvage value, one will automatically fall out because it'll be 60% of what was left in the last year. So let's go ahead and do it if there was no salvage value. So let's say that we have now no salvage value using double declining balance. So if I didn't have salvage, everybody see what we did here? Everybody's good. What would change now? What would change on these last couple if I decide I don't have any salvage value? What would I do? There's not going to be any salvage value left. It's just going to be whatever falls out at the end. I don't set one, in other words. It'll be whatever's left at the end. Okay, so what would be 40% of 25,920 here?
10,368.
10,368?
Yes, sir.
That's what we had, right? Okay, good. So let's put in the 10,368. All right, so we got 10,368. So now when we add up all four of those years, the 48, the 28,8, the 17,280, and the 10,368, when we add all those up, how much do you get for accumulated depreciation?
104,448.
104,448.
Yep.
Okay, and I should have put the 10,368 in here, of course. Okay, then that gets closed. Start over. Everybody's staying with me on that now. All right, so what do we have in year 5? What's my remaining book value? 120 that we started with, right? Less the 104,448 is how much?
15,500.
And what would you take for the last fifth year, for the fifth year of the last year? 40% of that. How much is that?
6,220.8.
221. I'll round it, okay, for our purposes. In real life, the computer doesn't care. Okay? Debit depreciation expense, credit accumulated depreciation. You like that? It's getting easy, huh? How many times have I said that? Over and over and over. You got it, don't you? How do you record a provision for allowance for doubtful accounts? Debit what? Allowance for doubtful accounts. Bad debt expense. Credit what? Allowance. When do you ever increase the allowance for doubtful accounts with a different journal entry than that one? Never. How do you record depreciation expense? Debit. Depreciation expense. Of course, it's expense. And credit what? Accumulated depreciation. When will you ever go to different accounts? Never. It's just different amounts. We got it? Don't make this harder than it is. Okay? It's hard. Accounting's not hard. Business is hard, right? People invent all kinds of ways of doing things. Okay. All right, so now what's my accumulated depreciation gain? I'm going to put 6,221 in here. Isn't that what we did? 6,221 in here. And then at the end of the year, of course, I'll close it and start over. And I won't depreciate anymore. Why not? Because I've done the whole 5 years. Okay. What is my accumulated depreciation? 104,448 plus 6,221, right? How much is it?
110,669.
And what does that leave me for a book value at the end here? 9,331 is what falls out as my residual or salvage value, right? Instead of the 20,000. See, this one just happens then. Any of the other methods, you'll depreciate the depreciable value to 0. So you have to set a salvage value, or you won't get one. So with declining balance, you just let it fall out. Okay? Okay, let's do. You want to do another method? We're having such a good time. All right. Okay. Everybody's good with these. Let's do let's do units of production. And what we have to say then with units of production is how much we're going to use the asset each year. We have to guess, okay? How much we're going to use it over its life, basically. So you can do this with a truck if you want. You can say how many miles you're going to use it, right? And however many miles I drove it a particular year is how much I depreciated. Things like forklifts, we don't keep track of the miles of forklift drives. We keep track of how many times it goes up and down. That's what we want. And really, it's how many hours we use. That's what we measure. And we figure we keep going up and down each time that it's running, right? Okay. So we're concerned with how many hours I'm running it, not with how many miles I drive it. So they actually keep track of the hours on the forklift. Okay, how many hours we're running, and then you maintain it based on the hours that are running. Make sense? So we could estimate how many hours it was going to take, how many hours the forklift was going to use. And then we could take the cost for the forklift, right? Less its salvage value, get its depreciable value, and divide it by the hours. And that's how much we depreciated every time we use it for an hour. And you can look at the meter on it and see how many hours you used it, right? That year. Each year you record depreciation for it. Does that make sense? So let's say I buy an asset. Let's keep our $200,000 or $120,000, but it's not a truck anymore. Maybe now it's a I don't know. It's a machine that we use to produce product. So we have equipment or machines, right? And what we're going to do is we're going to keep track of how many units we produce with that machine. Does that make sense? It's similar to the forklift with the hours. Or it can be a truck with miles, if you feel like. Okay? So what we're going to do with this method is we are going to keep track of how much we're using this thing. So let's say for that $120,000 asset with a $20,000 salvage value, we are going to get 50,000 units of finished product processed, okay? That makes sense? Whatever we're producing, okay? We're going to get 50,000 of them produced, okay? Out of that $120,000 investment. But at the end, we're going to still sell it for 20. So what do you want to depreciate? What do you want to do, guys? I still think I want to take the cost, which is $120,000, wouldn't you? Less what? The salvage value or residual value, which is $20,000, and what do you have? Depreciable value of $100,000. Everybody good? I'm going to depreciate that $100,000. I'm going to stop as soon as I have that all depreciated. But I'm going to spread it this time over what? 50,000 units. You got it. That's what we do. So every time I produce a unit, what do I want to do? These are dollars. Depreciate what? My little simple math, $2 per unit. And again, we don't care what the numbers are, right? Come up with anything, right? We don't care if it's $102,486.12 and it's 51,292 units for some reason, right? And we get some strange number, right, per unit. We don't care. It's going to work the same, right? So just relax when you're working these. I try to make the math simple quizzes. So anyway, $2 a unit, huh? So now what we have to do, we think it's going to last for 50,000 units and then we're going to sell it, okay? Right? Retirement. Now what we have to do is keep track of how many units we actually produce each year. Does that make sense? So I think it's going to last for about 5 years and I think I'm going to produce about 50,000 units. Does that make sense? But let's say it goes like this. So here's year 1, 2, 3, 4, 5. And you wouldn't know these until after you actually produced it. Does that make sense? You didn't know how much you produced till you did. So let's say our actual production. So this is actual production. This was our estimated production. Everybody got the idea? Estimated units, actual units. Okay? Let's say the first year is 15,000. Well, how much did we think we were going to use per year? Whoops, units. How much did we think we were going to use each period? 10. So we're already over, aren't we? Everybody got the idea? Could that happen? Of course. Okay, so let's say it goes 15, and then it goes 12, and then it goes 10, and then it goes 9. Okay. And then it goes 8. do that? Sure. So we did in the first 5 years. What do I want to calculate, you guys? Depreciation expense, debit, right? And what else? Keep track of the accumulated depreciation, maybe? Yeah. So it's just going to be this. I want to get, it's always this. I want to get depreciation expense per year. Goes to my income statement. I want to get accumulated depreciation every year. Okay? Okay. Did you notice when we were doing receivables, we were constantly trying to determine what should be on the balance sheet, what should be on the income statement? You know, for accounts receivable and sales, for bad and cash, for bad debt expense and accumulated depreciation, right? Income statement and balance sheet. Okay? We did inventory, cost of goods sold, inventory. We have different values for inventory. We have different values for cost of goods sold. Try to estimate what happened in the company. Okay? What are we doing here? I'd like to figure out how much should be in depreciation expense and how much should be in accumulated depreciation. That's what I'm doing now on the income statement and balance sheet. And it makes a difference in the net income, how we do this. Okay? So we're trying to get the best estimate we can, always. So how much depreciation expense do we have? That's supposed to be an R. Everybody always thinks that's a T. I get department expense from students a lot. They're just taking notes and just reading it. D-E-P-T, I guess, department. It's an R, right? And it's got horrible mixture. Depreciation expense, okay? I don't know what department expense is. Okay, anyway, depreciation expense. So what do you want to do? I did 15,000 units after the fact, at the end of the year. I got it. Debit depreciation expense, how much? $30,000. Credit accumulated depreciation, how much? 30,000. I had nothing in it, so now I have 30,000. Right, guys? 30. 30. Everybody good? That's where we're at. Then you're going to close the depreciation expense, aren't you? Oh, by the way, what was the book value at that point? 120 less 30 is 90. And we're going to keep going until we get down to what? 20. Okay, let's keep going. What's the second year? Debit. Credit. What's my balance in accumulated? And then we close this one after the year, right? I keep forgetting that. We wouldn't close it until we do financial statements, of course. What's my remaining, or what's my accumulated depreciation now? 54. What's my remaining book value? 120 less the 54, right, guys? Okay. 66. Okay. Are we good? What do you do the next year? Take 2 times it. 20,000. Debit depreciation expense. Credit accumulated depreciation. So we put 20 more in here. Later we'll close it. So all that's going to retained earnings, isn't it, guys? Year after year after year. Okay, and we put 20 more in accumulated depreciation with the credit. Debit depreciation expense, credit accumulated depreciation. Now what do we have in there? 74 is accumulated depreciation. 46 was the book value, right? We're going to keep going until we hit 20. Okay, so what's the next year? 18. We can do that much more, can't we? Debit depreciation expense 18. Credit accumulated depreciation 18. Everybody good? Later we'll close that, won't we? Before we start the new year. All right. So how much do we have in accumulated depreciation? 92,000. What's the remaining book value? 28. How much do you want to stop at? 20 salvage value. So even though this is 8,000, 8 times 2 would be 16. We're not going there, are we? Right? What do we want to do instead? We only want to do the difference, right? I only want to come up to 100. So I can't do 18. I've got to just do what? 8, and you're there. You guys are good. Okay? So what's that going to be? Debit depreciation expense 8, and what we've done is we put the whole 100,000 in depreciation expense, which when it's all closed ends up where, guys? Retained earnings reducing equity. I used it up, right? I don't have it anymore, so my equity goes down. I got rid of the asset, right? So I put 8 more in. I close it later. It goes to 0. Whoops. And then what do I have in accumulated depreciation? We already said it's 100. Everybody good? This is easy, isn't it? It is, and I'm going to give you a lot of points for this. But you're going to really understand depreciation. By the way, do I think in your careers the vast majority of you are ever going to do depreciation? No. Do I want you to know what it is when you look at a balance sheet? Oh, you bet. know what it is on an income statement? You bet. Because if you don't, you're really at a horrendous disadvantage against people who do. You don't know what you're doing, they do. That's why we're having you do this. How many of you love econ? Oh, come on, somebody's got to love econ. You haven't had it yet? How many have had it already? And you don't love it? Oh, gee. Okay, anyway, econ I really hated when I was undergrad. By the time I was in my PhD program, I thought it was wonderful because all it is theoretical accounting. And this is applied economics. It's the same stuff. It's hard to tell when you're taking the classes. Psychology really matters too. Did you know that? Why? You're going to deal with human beings your entire career. It's just amazing how that works. So does sociology matter. I'm not kidding. So does history. Boy, does history matter. Okay? So, like everything, love everything. When you're taking a class, I told you this already, what do you need to do? Figure out why that person standing in front of you spent their whole life studying whatever that is. They probably don't know either. If you ask me why I studied accounting so much, I don't know, right? It just sort of happened, right? But there's some reason they got into it. They found it challenging, fascinating, and so on. So if you don't like your theology class or your philosophy class or whatever, decide to like it. Try to find out what's going on. You only got to do one or two of them. Even in a strong liberal arts school like this, 2 theology classes, 2 philosophy classes, that's nothing, right? 2 econ classes if you're a business major, 2 accounting classes, right? You can do it. Only 1 finance class, 1 marketing class, 1 management class. Get into all of it. If you are an accounting major and you blow off your marketing class, you're a disaster out there. Are you guys aware that people sell stuff? And they have to advertise it and plan that and everything? Are you aware of that? You think it might be useful if you're, a finance, accounting type person to understand a little bit of how that works? It's very complex. That's the other thing that's really cool. When you go out and you start looking at real businesses, one of the things I really like about public accounting is you're constantly working on different businesses in different industries with different people. You're constantly in different places. Just learn all the time, right? Every business is so much more complex than you thought it was. You wouldn't, whenever it goes from mushroom farms, you wouldn't believe what goes into getting mushrooms grown. Everything's working against them. Diseases, insects, agriculture, it's agriculture, but it's strange agriculture because it's very scientific. They're growing mold, you guys. Mushrooms are mold. Mold that tastes real good, but it's mold. It's fungus, right? They're a fungus. It's amazing. So it's a whole different kind of agriculture. I had no idea what went into actually delivering stuff. And I have a tremendous respect for people who can actually run a mushroom farm. Man, it's amazing what they have to know and what they have to do. Every business is like that. A machine shop is just amazing. Anybody ever been to a diesel repair shop for trucks? Holy cow. You eat off the floor, huh? It has to be that way to destroy the engine they're working on. Get every dust inside. It's like they're in a laboratory or something. It's just amazing, right? The image that you have of somebody who's repairing trucks, right? Doesn't quite fit that. That's the way it is. Yeah. So anyway, all the different clients that you might have, businesses you might work for. We don't really think about that stuff too much until we're out there, and that's kind of fun stuff, I think. All business is really interesting. It just is. Okay. Anyway, so what was I doing? One more? Want to do one more? I know you do. Now you're having a lot of fun. I said that for the recording, in case anybody ever listens to it. Yeah. Okay. A couple of people have been telling me in both classes that they're actually listening to these recordings. I know I find it difficult to believe. It's got to be really boring second time around. But it's probably really useful. I listened a little bit myself and I thought, oh my gosh, it's horrible. But you never listen to yourself. I just turned it off. I didn't fall asleep. Who said that? Yeah. It would put you to sleep, huh? Yeah, terrible. Okay, anyway, yeah. But it doesn't hurt to repeat. It doesn't hurt to go through it. You might want to use some of these, just the ones you're having trouble with. If you're having trouble with, say you're having trouble with this area for some reason at the end, you can listen to what we did today. It'll come right back. Right? And then study too. So, yeah. In intermediate, I think they're starting to use them more than you guys do. That's because their material is more complex and they're going really fast. I'm going slowly here. Okay, you knew that, right? Yeah, just take it really easy. Okay, because most people don't think so. Okay, So I wanted to add one more. Let's do sum of the year's digits just for fun. And yeah, I'm going to test on it, quiz on it. Okay, make it a little more fun. Okay, this is an interesting method. It was for tax purposes at one time. It's not allowed for tax purposes. You have to use modified accelerated cost recovery system. A lot of companies, or not a lot of companies, some companies still use this. It's a lot of companies, but not a big percentage of companies. Still use this method. But it's kind of cool what they do. It's kind of clever. What you do is you count the number of years. So I got year 1, 2, 3, 4. Let's keep the 5-year life, okay? And I'm still going to depreciate 100,000 because this is going to take all of it, right? So I'm going to take my cost, which is 120, less my salvage value, which is 20, and depreciate just the 100, okay? What you do is you add up the number of years. So 1 plus 2 plus 3 plus 4 plus 5. This is crazy. What does that add up to? You get 15? Don't you do that? Is that what it was? Okay. So we get 15. So those add up to 15. And then what we do is we say, okay, the first year is going to be 5 15ths. The second year is going to be 4 15ths, getting the drift. Third year is 3 15ths. So this is an accelerated method. I'm going to take 5 15ths of the depreciable value of the first year, 4 15ths the second year, 3 15ths the third, 2 15ths the fourth, and guess what? 1 15th the fifth. And when you add up 5 15ths plus 4 15ths, 3 15ths, right? When you add them all up, what do you get, of course? 15 15ths, and you have depreciated all of it. Got it? This is easy, isn't it? Okay? I like to do this. You know, some people who didn't bother to come today, are they going to get this right? Maybe not. That's fine. If you don't go to work and you miss the meetings, what happens? Bonus is smaller. And if there's enough of them, you don't work there anymore. Right? You don't get promotions. You don't get raises. Go to work, you guys. Right? And I'm just preaching to the choir here, huh? Did I mention this to you guys yet, or was that intermediate last time? About what Pat Cass recommended? That you guys did the other class. Pat Cass was the managing partner at Arthur Anderson before Arthur Anderson sold it. Then he became the managing partner immediately at E1 here in town, Louisville's offices at Ernst & Young, and he retired as their managing partner. I had Pat come in here, and really nice guy, great guy, doing some teaching over for UL. Now he's retired, and he was visiting students like you guys, right? And I says, Pat, what one piece of advice would you give students? You know, what one piece of advice would you give for being successful? And you know what he said? Show up. And then he laughed and he says, but then you guys did it, so you did. Be prepared. Show up. You go. You show up. When we're working on a job and everybody's worked 50, 60 hours, maybe 70, maybe even 80, and you got to get it done for the client, and you're really under the gun, and you know when it's over, you get some time off, right? Thank goodness. But you're just cranking on it, and everybody's so tired, everybody's irritable, and you have a new staff person, and she has a really important date with her boyfriend. And my kids are at home, and I haven't seen them for 3 days, and you leave to go with your boyfriend. What do I think? Oh, by the way, I stayed longer to do the work than you would have done. How much do I like you? Not a lot. I don't ever want you on one of my jobs again. I'll do it. If you're going to take on the challenge, complete it. Your parents ever do this to you? You know, you're doing a little league, or you're doing soccer. You can quit after the season's over, right? But you can't quit during the season game. Don't take it on if you don't want to do it. It's okay. But then don't ask for the reward if you don't want to do it either. Okay? It's awful. It's awful. By the way, is it good to be away from your kids for a week? Of course not. Terrible. Is it good to be away from your boyfriend for a week? Yeah, probably would make the relationship better. Okay, big deal. Yeah. So don't think what you're doing is more important than what everybody else is doing. And don't think your boss ought to work hours that you could have worked. Right. By the way, what if you have a boss that always goes home after 40 hours a week and you're expected to work 80? You should be the boss. Don't you think? And pretty soon you will be, by the way, don't worry about it. I'll get rid of them. Right? We back off that much. Yeah. It's okay. All right, anyway, tell me how much depreciation expense I have. This is really easy. Go ahead and calculate it. You got to do it. And then the accumulated depreciation. And you know the journal entry is debit depreciation expense, credit accumulated depreciation, so accumulated depreciation is going to grow. And we're only going to depreciate, well, we're going to depreciate what? How much per 15th? I guess we could do that first for you. What are we going to depreciate? Total amount. It's a $120,000 asset, but we want salvage value of 20. What are we going to depreciate, you guys? We're going to depreciate 100,000, right? Divided by what? How about 15? What's 1/15 of 100,000?
6,666.666.
Okay, we'll round it, and then you'll have to just top off last year. Okay, to make it work out, or a couple of figures. All right, so what do you want to do? We'll round a couple of them. Well, what's last year? Let's do it easy way. What's last year? 6, 6, 6, 7. What's the year before that? 13, 3, 3, 3. Do a little rounding there for us. Okay? What's the year before that? 3 times it. 20,000, is it? What's the year before that? Add 6,667 to it. 26, 667. What's 5/15 of 100,000? 33, 333. What do all those add up to, of course? I told you guys to do it, and then I did it for you. How easy can that be? Everybody good? Those are all dollars, of course. Everybody got it? What's the accumulated depreciation as you go? First year, you debit 33,333. See, it's accelerated, right? So all we did was we listed the number of years, and then we counted them up, right? Everybody see that? And then we put 5/15 the first year, so you just flip them around. 4/15, 3/15, and so on. Okay, anyway, what if it was a 4-year life? It added up to 10, right? It'd be 1/10 the last year and 2/10 the year before, and work your way back. Okay, anyway, accumulated depreciation would be 33,333, right? Debit depreciation expense, credit accumulated depreciation. What would this one be? You'd add the two together, wouldn't you? Everybody agree? We need to do the T account, or you good? You'd be debiting depreciation expense for 2667 and 667, and 33,333 would already be there. How much does all that add up to? 60,000? So we're depreciating really fast, aren't we, guys? Okay? And then at the end of the next year, what would you have? 80,000. And we're going to go right up to 100, aren't we? At the end of the third year, what would you have? 93,333. And at the end of the fourth year, 100,000, and then we quit depreciating. Everybody good? That's what we're going to do. Too easy to believe. All right, remaining book value is still 20,000. Okay, let me ask you this question. A series of questions, maybe. Okay. Let's try this. Straight line, book value after, with our problem that we have here. So I just give you this problem, right? And these are the questions you can ask. So you have to work all of these, right? Straight line book value after 3 years. Double declining balance. Depreciation for year 4. Units of production. Accumulated depreciation at the end of year 2. Some of the year's digits, book value after 1 year. Make it easy. Find it easy. All right, go find those. Go find those 4. They're in your notes, right? Go find it. You could just work this problem. It's a monster, isn't it? This could be a whole quiz, couldn't it? maybe a third of the foot, half of the foot maybe. Somebody needs to go outside and have a field trip. Why am I not using the bot? Cool. Oh no, you have to know something. Yeah, and remember, imagine, we can't do this outside, right? Well, I don't know. I get talking, nobody listen outside as well.
Yeah, you're right.
Yeah, so maybe we could do that outside. Maybe go sit in the park.
We should know it by the time we come in, right?
That's right. Supposed to already learn it, right? It's one of those science subjects. It is. It might be too early. Now they have backpacks for students. You got the answers? You don't have to calculate anything, just go look them up. Did you take notes? We calculated a straight line, you guys. What was depreciation expense every year for the straight line? 20,000. What would it be 3 years? Yeah, 60. What was the original cost? So what's 120 less 60? 60. How many had it? Should be in there. You guys. All right, double declining balance, depreciation for year 4. Can't you just go back to where you did double declining balance? Find it. Double declining balance, what did I ask for? Got slow, that's moving, I don't know why. But depreciation for year 4, there it is. How much was it? Depreciation. This is double declining balance, right? 10,368, is that what you got? Yeah. Units of production, accumulated depreciation for year 2. Units of production, year 2, what was it? 54,000. Sum of the year's digits, book value after year 1. What'd you do there? Take 120,000 cost less what? 33,333. How much is that? 86,657. Yes! We can do it, can't we? Know what we're doing. So would it be really useful to practice some of these? What do you bet in the practice quiz I got out there from last summer you could do all these? Have you done it? How many have done it yet? 1. It's there, isn't it? Okay, good. 1. Good. Well, you got a weekend before the quiz, though, do you? We do, don't we? Yeah. That's probably good. All right. Let's do one more thing. We'll use some of the year's digits for this. Let's sell the asset, and let's say that we sell it after the end of the 4th year, okay? So at the end of the 4th year, so I've depreciated it 4 years, okay? So January 1st of year 5, everybody got the idea? I'm going to sell it. I'm going to have 3 different prices I sell it for, and I want you to do the 3 different journal entries, and I will let you out of here, okay? All right? So let's say, and it's at the end of year 4, is it? And let's say we're using some of the year's digits, so we're using this one. Everybody got the idea? Okay, so at the end of year 4, I sell it for $30,000. I sell it for $20,000. And I sell it for $26,667. Please write those 3 journal entries for me. What would you do? I'm selling this. What did the equipment cost me? $120. So I'm going to get rid of that if I sold it. I sold it for this much cash. It's for cash. I'm going to record the cash. And I also have what recorded on that equipment? Accumulated depreciation. You got to get rid of it, don't you? If you get rid of the equipment, you got to get rid of the accumulated depreciation. Right, guys? And the difference is going to be what? The difference between the book value and what I sold it for is what? If it's more, it's gain. If it's less, loss. Yeah. That's it. Do those 3. Bet you can do it. I bet you can do it. You already know how. quick. What's that there was? It went away. Well, try it. A little blue sky though. I get a beer and a crop. Oh, we're here again, another ball.
Oh, okay.
My grandson there. It's hilarious. We spend most of the time in the around.
I've only been over at the bat school.
Back, it's beautiful stadium.
No, it's very nice. I've only been there a couple of times. My dad only gets tickets.
Yeah.
It's his business.
I'm sure why not.
That's nice.
Yeah. Pretty sick.
I think it's like dollar beers.
Yeah, sometimes. It's not the one that costs 9 or 7. Well, not buying it. They have really nice IPAs now that look out there. That's some blue stuff. West 6. Rebel. Really? Do they have a separate area or can you walk around?
Walk around with it every day.
Walk around with it. I don't know. I don't know. Little kids and strollers drinking beer. Some settings just don't. And vehicles running around, people hopping on and on. I don't know.
They have like special events now too. It's, I don't know.
Oh, well, that's a little different. They have parties and stuff.
Well, I don't know that it's necessarily parties. It's like come out this Sunday for $1 beer and play with koalas.
Oh, my God. No, no, no.
Because my national work.
Well, I do want him to get funding for the zoo. We buy a season pass every year and go a couple times. You know, just the donation. We buy riverboat passes every few years too. We go once, we buy a pass, and we never go again. It's a donation. Keep the bells going. When you guys have money, be generous. I already looked at it. You go to dinner, it's 20%. You don't have to do it now. I know, it's killing you. But you have money. That person is serving you is making less than minimum wage. Come on. $2 an hour. Anybody work as a server? Yeah, it's awful, isn't it? 20%. Make a living. Good living. If they do a good job. If they do a crummy job, I don't think 20%. I'll leave at least 10 and then never come back. It's horrible. It's really good. 20, sometimes more. More if it's a really inexpensive ticket. Like $5, $10 worth of stuff or something. It's not generosity, it's just paying your way. All right, what do you want to do with the first one? Deb or what?
Cash.
How much? 30. Oh, we can do that on all of them. And if I had a problem like this, I probably would. It's going to be the same deal anyway. What'd you get rid of? How much? Yeah, be careful, it's not 100, it's 120, right? Okay. 100 was our depreciable value, wasn't it? Yeah. It's always 120, that's what the equivalent was, come on. Didn't matter what you sold it for. All right, how much accumulated depreciation do we have? That's the hard part. What do we do? It's the end of 4 years, wasn't it? We calculated it, didn't we? It was 93,333, wasn't it? Everybody good? And it's a credit balance in accumulated depreciation. How would you get rid of it? Debit it. You got it. Accumulated depreciation. 93,333. I hope me putting my hand on this thing doesn't hurt it. I guess it would, would it? But it's really hard to write on it if you don't press on it. My writing's impossible to read anyway. All right. What happened here? What is my book value of this asset? 120 less 93,333. What did we say that was? 26,667. Is that what it was? Okay, so if you sell it for 30,000 and your book value is 26,667, what's the difference? What do I need to make this balance? A gain of how much? 3,333. Ta-da! And luckily, the gain on sale of equipment, right? This is a non-operating gain. I'm not in business to buy equipment and sell it. Otherwise, it'd be sales and cost of goods sold, wouldn't it? I wouldn't be depreciating the thing. It'd be inventory to me, right? That's what Ford would do with a truck, right? Okay, this is a truck UPS is using maybe. Got the idea? So when they sell it, it's a non-operating gain. You like it? Okay? So I have the gain. There's no sales and no cost of goods sold, right? There's just gain or loss. Okay, what would this one be? I sold it for 20,000. It's got a book value of 26,667. I need a debit of 6,667. It's very convenient, huh? What's that? Loss on sale. It's got a book value of 26,667, and I sold it for 20,000. I lost 6,667. Everybody got the idea? That's a non-operating loss. Notice, gains are like revenues. They're credits, but they're not a revenue. It's not from selling goods and services, right? It's non-operating. Okay, and a loss is like an expense. It's a debit, right? It's reducing my income. Gains, credits are increasing my income, increasing my equity. Losses are like expenses reducing my equity because it reduces my net income. Got it? Okay, but there's no sales, there's no cost of goods sold. Right? I'm not in business to do this. And what's on the last one? That already balances. Why? Sold it for book value. Right? You know what's really cool? I had a client one time. They would buy really nice, beautiful trucks, and they were doing repair jobs, and they drive all over the city. This is in Tacoma, Washington. They drive all over the city and repair appliances. Right? So they're a little repair company. And they have these gorgeous trucks they buy for their repair guys, right? All guys. Sorry, it was a long time ago. But anyways, all guys. But anyway, what they do at the end of the life of it, first, you had to use only your own truck. You couldn't use anybody else's. You could use yours, right? In fact, they'd never let you use theirs. Everybody had their own truck, which cost them more because they had a lot of trucks that way, right? But the deal was, the person who drove the truck was responsible for maintaining it, keeping it clean, right? Keeping it running well, you know, making sure the oil was changed at the right time. The company paid for change the oil, but they made sure. And then spark plugs were done and everything, right? Tune-ups. And then at the end of its life, they gave it to them. Now those trucks would have a couple 100,000 miles on it when they gave it to them. Pickup trucks. There's a lot of miles on pickup trucks. But what kind of condition do you think they were in? Oh, they were cherries. They were just gorgeous. Why? They were going to get it, and they knew they were going to get it. It was one of the perks. They could have sold them for a couple $1,000s each. Instead, they gave it to them. You know how much they saved on maintaining those trucks? They'd never break down. They were always maintained properly. They didn't get in wrecks with them. They were going to get it. If a wreck was real unusual, never their fault. Right? How smart is that? And guess what? All those guys thought that was a really good deal. So you see the old truck in the parking lot they're driving, and then they come and get their new one with all their tools loaded in it, you know, and everything, and go out and work. Yeah. They every single one of them had the old one. Now we're, I don't know, 300,000 miles on it or something, right? But running good. See you guys.